All right, meantime, the 10-year Treasury yield hitting its highest level in 10 weeks on the back of today's auction and Fed minutes. This is investors await tomorrow's CPI print. For more, let's bring in Andy Constan. He's a CEO and Chief Investment Officer at Damp Spring Advisors. Andy, great to have you with us. I think the last time we spoke to you was certainly before the last Fed meeting, so a lot has sort of changed in market psychology. What do you make of what we've seen so far?
Yeah, since Jackson Hole through the FOMC meeting and even after that, the markets were concerned about the labor market. The Fed was concerned about the labor market. The Fed was concerned about overall GDP and was quite satisfied that inflation had returned to was on the way to returning to target. And all that changed over the last couple of weeks. In particular, it started with, well, obviously the September payroll data was a big surprise on the upside in terms of how strong the labor market was. But prior to that, the gross domestic income, GDI, which is conceptually the mirror image of GDP, had been significantly weaker than the GDP was, which was a concern that it was leading the GDP down and the conditions were worse. That got completely revised away. And Chairman Powell at the NABE, at his appearance at NABE, highlighted this and said that it removed some of the downside risk to the economy that the Fed was worried about. And he then directed the audience to look at the SEP, which has two more cuts of 25 basis points in it, trying to walk back what at that time was the expectation of at least one 50 basis point cut and possibly two. And today we're at less than two cuts. It's been a big change driven by the GDP and the labor market. Both of those two things, along with core PCE, are what the SEP dot plot uses. It just mechanically uses it through their reaction function to determine what their target policy rate is. Two of the three things are now well above what they projected. And just a few weeks ago, the unemployment rate is at 4.05, and they had projected 4.4, and there are only two more reports between now and then. And the GDP now is priced at 3.2%, and they had projected 2%. So it's going to require a very, very icy cold CPI number and then subsequent weakness in jobs and GDP for them to get anywhere near their SEP projection. And so it's possible that even a pause gets priced into markets.
Andy, it's Karen. Thanks for being on. So I know you've sort of been in the higher for longer for a while, which this seems to dovetail with that. Do you think the equity markets are just too optimistic for 2025 cuts?
Well, I mean, I think there's two questions on equities. One, will the earnings, which are elevated growth rates expected of 12 to 13% for the next 2 years, are those going to be realized? They could be. In fact, a strong economy even with above target inflation gets them closer to those earnings. So that's good. Higher for longer is good for equities and that earnings come in well. It's valuation that gets hit when long-term bond yields start to rise. And so are valuations cheap? 22-ish forward-looking guidance on elevated earnings doesn't seem cheap to me. But it's a question. Now, will the Fed's rate cut is what is keeping multiples high? The expectation of significant rate cuts? Or is it something else? And that will be seen.